Today I was going to talk to you about some of our loan products that will benefit you in your operations. And as we think about what those products are, just our loan products here. The first one is operating loans. How many of you have operating loans? Okay, a few hands out there. How are they used? Why do we need an operating loan? Okay, because you produce something throughout the year and you generally sell it in the fall or one time a year, and so you have to cover those expenses along the way to get to that point so you can market that product before they come back in. So that would be our marketing or our operating loans just for the day-to-day operating expenses to cover those, and family living expenses as well, and debt service. Okay, they can also be used for livestock, for feed, for your dairy or cattle operations. As I mentioned, living expenses and taxes, family living expenses along the way. Okay, we have several different types of operating loans. We have budgeted operating loans. Now, we used to use these a lot, and these were set up for the entire budget. So if you had let's say you had a $600,000 budget, what these budget operating loans are for is to cover each and every expense throughout the budget period. And as the income comes in, it just pays it down. It can't be revolved through, and so it just covers all of your budgeted expenses throughout the year. So it might be $600,000, whereas if it were a revolving line of credit, you might be able to get by for maybe $200,000. So we don't use these budgeted lines quite as often as we used to. I don't know if anybody still has these or not. And then we have our revolving lines of credit, which many of you are familiar with. Now these have a peak amount to them. As I mentioned, maybe it'd be a $200,000. So as you get your income, it pays in, and it can revolve through many times in some cases. It depends on the individual. Most of these revolving line of credits are for more of your experienced producers that are very good managers. And so it depends on the type of commodity it is, if it's required to pay to zero or not. So some of you may pay them to zero, some of you may not. It just depends on the conditions related to that loan and where you're at in the cycle. Then we have non-revolving operating loans. Now, as you think about what these might be, it'd be for a single item, and not necessarily a revolving, but let's say you're building a hay shed or something. It could just be for that single purpose, and then the income would come back and pay it off. Okay, and the loan terms on operating loans can be anywhere from 1 year for a budgeted operating loan, or up to 3 years for a revolving line of credit. Now, typically we'll set those up for 1 year, but if we're comfortable with the way you're operating, the management that you have, we can go up to a 3-year approval. Many of you probably have those. And of course, the revolving line of credit, the advantage of those is they're more flexible. As that money comes in, you can revolve that money through time and time again up to that peak, as long as you stay underneath that peak. Now, I mentioned here that we can go 5 years with an FSA guarantee. Now, we have a lot of our FSA individuals here, and so I'm going to rely on them a little bit. And I think the reason they asked me to do this particular portion is because I used to work for Farmers Home Administration 25 years ago. I think they forgot that I forget. I can't even remember what I had for breakfast, let alone 25 years ago, some of the programs for FSA. But we'll go into those here shortly. And we work in unison with FSA on guarantees and splitting loans. Next, we have our intermediate term loans. What do you think these would be used for? For what was that? Equipment? Okay. New and used equipment can be used for that. Irrigation equipment and improvements. Many of you have done put in new pivots. They can be used for pivots up to from 5 to even 10 years on irrigation equipment. And production and processing equipment, as well as repairs, improvements to maybe your dairy facility or whatever buildings you might have. Debt refinancing. Many times as you come in to visit with your loan officer, he'll look at your balance sheet and see that you just purchased an item of equipment. You paid 8%, and he can refinance that for 4%. And so we can do debt refinances as well. Herd expansion, as Ross talked about, how you always want to buy the neighboring rancher to expand your herd or buy their permits. We can put permits on intermediate term loans. Okay, and then any other agricultural purpose where it's not an annual operating type thing, we can put on these term loans. As I mentioned, the terms on these would be 3 to 7 years, or if it's irrigation equipment, or if we have real estate, we can go up to 10 years. Next, we have long-term loans. Now, Ross talked about those, and many of them have talked about the long-term loans. As you look at your balance sheet, we have the current assets and liabilities, and then you work down the balance sheet, the intermediate, and then the long-term. Long-term would be your real estate. And so these loans will be real estate in nature. They might be for facility purchases or improvements to your operation, be it a dairy, turkey, whatever the case may be, or for water and irrigation improvements. So if you're going to put those pivots on, as I mentioned, you can go 10 years if we have real estate, but if you want to put that over a longer period of time, a bigger expansion on your irrigation, we can go up to 20 years and even 30 if we need to. And again, debt refinance. Okay, how many of you have ever heard of a mortgage equity revolving line of credit? Any of you ever used these? How many of you have a home equity loan? Okay. This is the same concept as a home equity loan. On this mortgage equity revolving line of credit, real estate is taken as collateral, and then you have a draw period of 5 years, and so you can use that revolving line of credit secured by real estate for any purpose, any agricultural purpose or commercial purpose, if you're a full-time farmer, for improvements, for operations or whatever. And then at the end of that draw period, it will be amortized over the 20 to 25 years remaining. And that's a great product. I don't know if any of you were aware of those or not, but they work fairly well. I've got several down there in Cedar City, and they use those for hay barns, for whatever they're trying to build up to, or expansion of their buildings or sheds, or however benefit them. So the long-term loans, then we can go from 5 to 30 years. And they can be fixed or variable rates. And the other thing that you may need to be aware of is those fixed rates they don't have to be for the duration of the loan. They can be, let's say you get a 20-year loan, you may want to just fix that rate for a 5-year period or a 10-year period per se, and then the rest of it's on a variable. So we have many products that we can work with you on rates. And I didn't mention on these other loans, the intermediate loans, they can be structured to coincide with your income stream. So if you are receiving a monthly income, we can set the payments up monthly, or we can go quarterly, semi-annual, or annual. If you have a one-time sale of cattle, we'll try to put that payment due when you sell your calves in the fall. Okay, balancing the balance sheet. And you wonder, how do you do that? And of course, we've had some great insight this morning and this afternoon from Ross as well on how and why it's so important to look at our balance sheets and understand what they are telling us. And I'm going to reiterate some of the things that Ross talked about on the balance sheet. it's important to structure your asset or your debt with the appropriate life of that asset. How many of you remember 2008 when the housing market hit that bubble and everything fell to pieces? Before that, people were going out and they were buying the house. It could never go down, and so they bought a $500,000 house, only to see the value of that house drop in half. So that house may have been worth $250,000 2 years later. At that point, they tried to go refinance it or restructure it. How successful do you believe they were? So it's pretty hard to do that. And so if you try to buy an asset on a shorter term than it should be set up, you can run into problems. Another example that we have down there in Cedar City, you're talking about hay prices. We had hay prices down there last year of $280 a ton. And so a lot of people would go out and they would buy a neighboring farm on a short-term contract based on the cash flow that they had last year. And all of a sudden those hay prices have dropped by 40%. And now they don't have the money to meet the obligations of that purchase. So it's important to structure your debt. What I'm saying is structure your debt with the life of that asset. And we've already heard about that if you go out and buy cows, you don't want to structure that cow over 20 years because she's going to die in 5. So it says here that the value of assets move independent of debt owed. Now, as you look at that, how could that be the case? Let's say you bought a pickup last week. You paid $50,000 for it, and yesterday you got in an accident. What's the value of that pickup? You owe a lot more than it's worth, don't you? So the value of the asset can move independent of the debt. Okay, working capital. Ross just already gave us a good explanation of working capital here. But working capital would be things that you can turn into cash in 1 year versus things that you must pay back in 1 year. And it's important to have this working capital because it gives you opportunity. If you have $50,000 in the bank and you're earning 0.5% interest, you're not making a lot of money on that. However, if the neighboring farm comes up and you have an opportunity to go buy that farm because you have that cash available, that opportunity cost is a lot better than if you had to go borrow 100% and you didn't have the cash down payment. Similar to the example that he showed us. So there's an opportunity cost for not having that working capital. Okay, and working capital is also a measure of a company's efficiency and its short-term financial health. So what you want to do when you're structuring your debt is to look at the worst case situation that you can make it through and structure your debt to that end. Okay, intermediate assets, be it livestock or equipment, if you buy those at the highest and then you try to pay them back faster, you need to, when you're receiving high prices, you want to pay. If you just went out and bought a cow this last year for $2,500 and you got a debt on her for $2,500, you may want to pay her back as fast as you can while the prices are high, because next year she's only going to be worth $1,000. And so structure your debt so that you can get them paid back in a fast way at the top of the market. So match your payments to your income timing. Many banks will require interest only or interest payments monthly or maybe semi-annual, but you only sell your product once a year. So in effect, you're having to borrow money on your operating loan to pay interest. And of course, we don't want to pay interest on interest. And so make sure that you get that structured so that it times with the sale of your product. Okay, repayment strategies. Going back to Dave Ramsey, he has strategies, what's the first thing you should pay back if you have excess money? Your short-term credit cards, that sort of thing, your short-term operating loans. Why? Because when you pay that back, if you ever get into a difficult, tight spot, you can draw that back. If you had that extra money and you put that down on a real estate payment, or even prepaid real estate, and then you get into a difficult time, is that available for you to draw back? It's not. And so in your strategies then, pay off your short-term things first, and they're generally the highest interest rate you have as well. Second, pay off your small loans. Those small loans, as you get rid of those, that's going to increase your cash flow that's then available to pay other loans. And then third, pay off your intermediate type loans, and then fourth and final, to pay off your long-term debts. Because again, if you prepay those, you can't get that money back. Okay, moving into our young beginning small farmer program here. How many of you know what a young and beginning farmer is? Some of you are. Many of you have been there, of course. But it's our goal to help the young and beginning farmers, and small farmers for that matter. Now, a young farmer is anyone underneath the age of 35. And a beginning farmer is someone who has less than 10 years experience, and a small farmer is someone who produces less than $250,000 in agricultural commodities in a particular year. Our programs are intended to help those young and beginning farmers who are committed to agriculture at similar rates and terms as those individuals that are well established. Of course, as you're beginning, you don't have the asset base, you don't have the cash flow, you don't have the history, you don't have the management. And with these programs, what we look at is we'll give you some discounts to try to make it so that you can have a viable opportunity to be successful. And a lot of times these work with our relationship with FSA, with guarantees, and with partnered programs. Young and beginning farmers may face more challenges in obtaining credit than established larger operators. Young and beginning farmers have more similarities than do small farmers. So many times small farmers are small by choice. They just want to run kind of a smaller operation, maybe it's on the side of a day job they have somewhere else, and so they don't want to expand. But we can benefit them because we have some abbreviated loan programs where we can go through very quickly on maybe credit scored loans, and we don't have to put as much time and effort into those, and so we can get them good rates and terms as well. Okay, why is it hard for these individuals to get into farming? Because, as Ross indicated, it's very capital intensive. And they don't have the cash sitting around to go buy the neighboring farm or to expand. And so it's a lot tougher for them to get involved and get going. Young and beginning producers often fail to have the financial resources necessary to meet a lender's underwriting standards. As been indicated, we have standards that we try to achieve. We don't want your debt to equity to be too high. We want adequate supply of working capital. We have quite a few standards that we would like you to adhere to. But we'll give you some concessions on these young and beginning programs. Okay. We've talked about some of these things. They just don't have the money to get into them and get involved in it. Limited history with the young and beginning operators, and limited experience as well. So, and I've talked about how we can benefit you. Now we have, as been alluded to this morning, we have different 6 different risk categories that we look at for acceptable loans, and they range between we call them a PD, which is a probability of default, And they range between a 4 and a 9 being an acceptable loan. Now, if you qualify as a young beginning operator, we can actually, and let's say you come in at an 8, we can actually reduce that down to a 6, and so you'd get the benefit of the rates that would pertain to a PD6 type customer, because each of these risk ratings carry an interest rate with them, and so we can give you a better discount on these programs if we utilize the young beginning program. And also on the collateral, we can go a little bit higher on the collateral than we would typically. Okay, this is where I need the help of our FSA people. Like I say, it's been 25 years since I worked there, and so I don't remember all the programs that they had. But they have many programs. They have the farm ownership program. They have the operating loans. Now these are both direct loans and guaranteed loans. Okay, this is a program that they have, and I've never seen these. But if you buy a farm from the neighbor on contract, FSA is able to come in and offer a guarantee to that contract holder to help them so that they can sell it to you. And that's a great way for this young and beginning individuals to get into a farming operation. They have youth loans. Now these youth loans are, I believe it's up to $5,000. This is for 4-H and FFA type products, club cabs, that sort of thing. They have these micro loans that are less than $50,000, and those are a direct loan. I don't know how you use those. Okay, so it's kind of a streamlined loan package is what it is.
Streamlined operating.
Okay. Now they have these emergency loans as well. These are direct loan, but I believe that these are only available when there has been an established emergency in the area. So if you have a tremendous drought and they come in and give you an emergency designation, then you could, floods or drought or some disaster. Conservation loans, these can be guaranteed. Now how would you use this one?
Those are primary loans for like irrigation purposes to provide, more efficient irrigation. I guess it might fall in that category. Again, that's not a program where you use a lot.
A lot of times they'll go through soil conservation on these type of things through ARTL. They're available, but they do, FSA does have this program that is available if you need to pursue that. Oh, there's their website that you can go look at all these different types of products and see what's available. Okay, the farm ownership loans they have can only be used for the purchase of a farm or a ranch. It can't be used for any other item whatsoever. And on the direct loan, it can be up to $300,000. And I think it's a combination of, they can only be $300,000 total. Is it a combination of both the farm ownership and operating loan? So if you have a $100,000 operating loan, you can only get two separate, so up to $300,000 on farm ownership. Okay, if you get a guaranteed farm ownership loan, and let's say you get a loan with up to the $300,000, then you can get a guarantee up to the $1,392,000. I guess they don't talk in whole numbers.
It's $399 actually.
Is it $399? It just changed then, evidently. Okay. Okay, and then we're going to talk about some of these variations. There's the down payment program, the joint financing arrangement, or the 50-50 program. And what are the benefits? Minimal to zero down, lower rates and longer terms. We can typically go 20 to 30 years. FSA can go up to 40 years. And we have to have, Western AgCredit, you need to have 30-35% down. FSA, 0.
The program that we're probably most excited about for the young and beginning farmers that you're talking about is a lot of times a young and beginning farmer is not going to have a down payment. And they may come in, they want to buy most farms are going to cost about $1 million these days to get what you need. Where we come in with that $300,000 is we will provide the $300,000 at 2.5% interest for 40 years. And we'll come in behind Western Ag on our loan. And so essentially what we do is provide the down payment so that Western Ag
Can do and then that puts Western AgCredit in the first lien position where we need to be.
Also guaranteed.
Right. Thank you. Okay, if you do get a guarantee, there's a 1.5% fee that goes along with that. And this is right along the lines of what we were just talking about here. Okay, the down payment program, the 50/50, or this is the 5% down that you would come up with, and then FSA would go with the 45%, and Western AgCredit would come up with the 50%. But theirs is limited to the $300,000 that we talked about before. And so that will work up to a purchase of $667,000. Now the FSA rate is 4% below the direct farm ownership rate, but no less than 1.5%. And I'll hit the rates here in a minute so you know where those are at on a 20-year term. So the 50% comes from, let's say, Western AgCredit in a first position, as Corey indicated here. And it must be 30-year amortization with a balloon payment of not less than 20 years. And then, again, they'll come back and offer a guarantee. And in that case, it's up to a 95% guarantee rather than a 90% guarantee. But they can't have owned a farm greater than 30% of the county average. And you have those numbers, is that correct? So you'll need to see your FSA guy for that. Okay, the 50/50 program, they will provide up to a 50% direct loan, or $300,000 maximum, and then another lender can actually go more than 50%. So we call it a 50/50, but actually it can go up to $1 million, as you've discussed. And so Western AgCredit in this case would come up with the other $700,000 in a first position on the real estate. Now, in this case, the FSA is 2% below the direct farm operating loan, but not less than 2.5% fixed on a 40-year term. Now, the one thing that I needed to mention on the direct farm ownership loan, they will take 100% of the asset, but if you have some additional collateral, they will go up to 100. They'll have to take that as collateral and take up to 150% of the loan. Okay, on farm operating, again, they can go up to $300,000 for normal operating expenses, as we talked about, machinery, equipment, cattle, whatever the agricultural purpose is. The operating loans are 1 year and can be up to 7 years, because they're calling their term loans operating loans as well. And you can get guarantees on those, again, up to the $1,999,000. Or $399,000, excuse me.
They're not revolving.
They're not revolving, it's a direct. Okay. Okay, and we talked a little bit about this contract. We'll just blow through that quickly. If you have questions, you can see FSA on these. If you're wanting to sell your farm to a young beginning producer, or even if you have one, if you want to get a guarantee on those, that can be a good risk management tool for you. Okay, we talked about the youth loans. Those are $5,000. I don't know what the criteria is. Do they have to? It has to be a 4-H or an FFA type product. Is that correct?
10 years old.
10 years old. 10 to 18. 10 to 21. Okay. So there are several options we can do here. You can use FSA with a guarantee. There's the joint financing. There's the down payment program. Or there's just the FSA, or excuse me, the Western AgCredit loan program that we use with the young beginning producers. And again, we will, if we get a guarantee, Western AgCredit will allow for those reduced rates. And with a guarantee, we can go even a little bit lower to help offset that 1.5% guarantee, that 0.5% rate reduction. Western AgCredit's loan, again, cannot exceed 70%, and so that's where you can benefit by using these FSA programs. And you get a better rate. I'll go through these fairly quickly here. Okay, on the young and beginning, with no FSA program, you typically have to be better than 10% better than our standard margins, but we will allow for those higher leverage positions if we use the YBS tool, and we can go up to 80% on operating loans versus the 70%. Okay. Now, many times you don't want to use the FSA program, or you have somebody coming in and their father wants to co-sign with them to guarantee it, or a grandfather will even co-sign. In these cases, they're already qualifying for some of the best rates we have because you're looking at the grandfather or father that's well established. And in this case, you wouldn't have to use the FSA guarantees, and we can just do it directly without even having to do this, but it allows for the young beginning producer to get in. And then you don't have the size limitations that are imposed by the FSA, the 1.4 million. Okay, here are the rates for FSA. Are these correct as of today, or are they changed? They've changed again? This was as of September 1st, so I figure with the new budget they may have changed a little bit. But you can see those are very competitive rates. And so you could benefit by utilizing those programs. And those are available through us, and we work, like I say, we work jointly with FSA. Okay, let's look at some examples of how you could apply this. Let's say we have a $600,000 sale. You're going to buy the ranch next door for $600,000. The standard way, you'd have to come up with $210,000 down out of your own pocket, and then you would borrow the remaining $290,000 over 30 years, would result in a $21,000 per year payment. Another thing you could do is you could provide $382,000 worth of additional collateral. You might have you already own the farm, and so you may want to put it up. In that case, you would borrow the full $600,000. Your payment would be $43,600. Or if we went with the FSA down payment, you'd come up with 5% down, or $30,000, and then the 50% or $300,000 over 30 years with a payment of $21,800, and then FSA would provide $270,000 over 20 years at 1.5% with a $15,700 payment, for a total payment of $37,500 per year. In this case, you're only having to come up with the $30,000 down rather than the $290,000. Or if you went with the 50/50 program, Western AgCredit would provide $300,000, which again would be the $21,800 per year. FSA would come up with the other $300,000 over 40 years for a total payment of $33,400. So you can see how that would benefit you in working down through that. Same situation, $900,000 this year. We can work down through it. Same thing here, but you can see how those different programs will benefit you. Okay, then, what we're looking at then, as I've discussed, is proper terms on your balance sheet. Balancing your balance sheet, it's important to work on your credit, to have those good credit scores so that you can come in and we can do streamlined loans for you if needed. Your credit score always helps. Take good care of your credit. Structure your debt so that you can meet your obligations in a worst-case situation. And the FSA programs, Young Beginning programs, guarantees are all there and beneficial for you. Don't be afraid to come in and ask us for any questions if you have. We'd be glad to work with you. I know that there's been some questions. Can you come in and talk to your loan officer? Absolutely. We would love to help you through these things and help you structure your debt.